recording this.
You know, we, in the 58 years approximately that I've been connected into the investment business, I've seen a lot of turmoil over the years. The first turmoil I ever saw was in May of 1962 during the Cuban Missile Crisis. And those of us, I see a lot of gray hairs around. Back then, the average volume on the New York Stock Exchange was probably about 4 million shares a day. In May of 1962, during the Cuban Missile Crisis, we had a crazy day. The ticker tape ran till 8 o'clock at night, and we had a grand total of 14 million shares. The 60s was a pretty good time until about 1968, when the Dow Jones hit 1,000. And, you know, again, we've had multiple predictions at the time of we're going to the moon, etc. Well, in 1968, when the Dow Jones hit 1,000, it didn't hit 1,000 again until 1982. That was 14 years. That was probably the longest bear market that I remember in my lifetime. But what it did was leave an indelible mark on my thinking that if it happened once, it could certainly happen again. Now, if I look around the room, from my perspective, most of the people's here prime objective with their investments should be low risk and have a moderate return. Now, if you need money at this stage of your life, you're in trouble. Because if you lose what you got now, you don't have a chance to earn it back. If I was talking to a 25-year-old audience, I think I would have a very different perspective and a different outlook, and you know, talk a little bit differently about what the markets are doing today. But after 1982, or 1981, 82, Paul Volcker was the chairman of the Fed. And in my lifetime, there were only two chairmen of the Fed that actually did what the Fed was supposed to do. One of them was Paul Volcker, and the other one was William McChesney Martin, who was the Fed chairman during the 60s, who came out with the famous statement or line that when the party gets going, you got to take the punch bowl away. Since Paul Volcker, we've had one Fed chairman after another that has believed in money printing. And one of the primary reasons why the markets are where they are today is because the Fed is clearly printing money. Now, we know throughout history, when central banks print money, eventually that leads to disaster. The Fed balance sheet, starting in about 2010, right after the great financial crisis, Ben Bernanke was the Fed chairman at the time, And they decided to start with QE1 and then QE2 and QE3 and Operation Twist, etc. And they got the Fed balance sheet up to somewhere around $4 trillion. And then when we were supposedly getting out of this funk, and let me back up a second, he did that primarily to save the banking system. So, and they try to just keep liquidity into the system. But since that time, theoretically, we were supposed to be shrinking the balance sheet. But what's happened since then is we got up to 7 trillion is where we are today. We had a minor try at shrinking the balance sheet in the fourth quarter of 2018, and the market rebelled. So market went down, and immediately they stopped. My guess is that they are going to probably continue to print money as long as the market lets them do it. So this is in the 1960s and 70s, there was a show on PBS called Wall Street Week with Louis Rukeyser. And one of his frequent guests was a guy named Marty Zweig, who really coined the phrase, "Don't fight the Fed." So that's where we are today, with the Federal Reserve basically buying everything. They're buying things that theoretically they're not supposed to be buying, like junk bonds, and they're probably even buying ETFs at this point through some special acquisition corporations that the Treasury has set up. So as long as the Fed continues to have credibility around the world, the markets probably will continue to go higher, because we're not based on fundamentals anymore. We're based on pure speculation. How high is high? I have no idea. But I put together something that said, as a little paraphrase of the opening lines to A Tale of Two Cities. It was the best of times, it was the worst of times. It was the birth of new economy stocks, it was the death of old economy stocks. It was a time for unparalleled gains, it was a time for disappointing results. It was a rise of concentrated portfolios. It was the fall of diversification. Earnings and market share were passé. Business models ruled the day. It was the US stock market during the COVID pandemic. That's where we are. And if I look around the room, as I said earlier, most of the people here should not be trying to shoot the lights out or try to make a lot of money, because I don't think there's anybody in this room, and I don't have any idea what your net worth is, and I don't really care, that it can really afford to take a big hit to their nest egg. Because if you do, it's going to change your life. And you don't have a chance to earn it back. So, I think it's great that the market's going up every day, and it's great if you're participating in it. But be aware that markets are very volatile. Now, I spoke earlier about 1981-82, when Paul Volcker was chairman of the Fed, and his main goal at the time was to break the back of inflation. Inflation at that time, people probably remember fairly well, was about 12%. Mortgage rates were 15%. It was a crazy time. So interest rates were 15%. They got on the short-term rates, they got up to about 20%. Inflation was 12%. And the price-earning ratio of stocks in 1981 was 8 times earnings. Now, if we take a mirror image of that, we're basically at 0 interest rates, 0 inflation, and the stock market, based on whatever kind of earnings you want to put on it. Well, last year, the S&P 500, they had $160 in earnings. There are estimates this year by some people at $100. So that would be at 3,100 on the S&P. That's 31 times earnings, which in my opinion is pretty high. Some people might think it's not high, but at the end of the day, we're at the mirror image of 1981, where interest rates basically have nowhere to go but up. I'm not saying interest rates are going up tomorrow, but the long-term gains on bonds is coming to an end. But right now you have this extraordinary condition where the Federal Reserve is buying bonds. So as long as the Federal Reserve is buying bonds, interest rates are going to be capped. I mean, I don't know whether the 10-year goes to zero. They did that in Europe. It's in Japan. And if we look back in Japan, which is another great example that I like to say, those that don't remember history are doomed to repeat it. Most of us remember back in the late 80s, Japan Inc. owned the world. They couldn't do anything wrong. Their version of the Dow Jones, the Nikkei 225, was at 40,000. It was, infinite times earnings. They were the model for the world. Well, here we are 30 years later. The Nikkei is at 22,000 or thereabouts, down 50% after 30 years. We won't live that long. So, those that think that markets are destined to only go up, and, and this is not a political statement, based on the tweets by the current president talking about how great he is for the stock market. I think that that's wishful thinking. Those of us that remember back around 2000 when we were in similar kind of situations, and I'm going to show a few charts in the next couple of minutes, that shows, again, in 2000, I remember giving a speech in New Orleans where I was telling people to beware, be careful, markets are selling at ridiculous multiples. Well, if you took a basket of the top selling stocks at that time, you had stocks like Sun Microsystems that doesn't exist anymore. You had Intel, you had Microsoft, you had Cisco, CISCO, not SYSCO, and lots of Lucent was another one at the time. Well, several of those companies are no longer around. And in many cases, including Microsoft is one of the darlings today, and I'll talk a little bit more about that in a few minutes. But it took you 16 years to get even on Microsoft. So when we talk about the FANG stocks, there's lots of them are selling at, 10 times revenue, not earnings, 10 times revenue. Which I think is a little bit excessive. So we are no longer in the world of reality investing. We're in the world of momentum, of rumors, of the next cure for COVID or whatever. But we have left investing reality as I've seen it over my career. I'll give you a couple of quotes more, a couple of extra quotes. Bob Farrell, who many of you may know or may not know, Bob Farrell was the Merrill Lynch strategist starting in the 60s, and he was probably there until 2000 and change. David Rosenberg, who some of you may know who he is, a chief economist at now Rosenberg and Company, was a Gluskin chef. He was chief economist at Merrill Lynch for a good deal of time. Always quotes Bob Farrell's rules of investing. Bob Farrell said, excesses in one direction will always lead to an equal excess in the other direction. Well, in 2000, we saw the market, the NASDAQ at the time, hit 5,000, which was, just explosive off the top of the charts. And many brokerage houses at the time were saying that markets can't go down. But in the next 3 years, the NASDAQ was down 80%, 80. So this is something you have to be aware of. And, I'm not saying it's going to happen tomorrow, but it's certainly in the cards. Another famous strategist, a guy by the name of Ed Yardeni. Some of you may know who he is. Ed Yardeni was chief economist at E.F. Hutton back in the day. And then he was the guy that was promoting Y2K, that it was going to break the system, et cetera, et cetera. He now has Ed Yardeni and Company. He said, the Fed gave up bazookas, skipped helicopters, and went straight to B-52 Stratofortresses bombers to carpet bomb the financial markets with cash. The immediate reaction of the financial markets was, it's raining money. Hallelujah, it's raining money. And I think that, and one more quote and then I'll stop with quotes. David Tepper, a famous hedge fund manager, I think he owns the Carolina Panthers now also. The market may be the second most overvalued I've seen, just behind the dot-com bubble in 1999. There's a lot of liquidity and the Fed's still there. It's too hard to say the market can't go up or something like that, but it's not a very risk-reward market. So, when I talk to my friends here, I don't advise people on their specific investments, because all that does is get you into trouble and make enemies. And I'm not about to talk about specific investments here today, other than to talk about markets and generalities. But there are many, many problems facing the United States at this time. One of them is the deficit, which now, we've lost control of that. I think the deficit is going to be about $4 trillion this year. I don't think that's sustainable. Debt levels of the United States right now is about 26 trillion.
Right. So I think some of the things are always useful to look back and to, get a perspective of what's going on today. But, from 60 years ago, it's definitely a different world today. I think a couple of things as we look back. I've been working now from home for the last 4 months. And if you step back even over the last 4 months, the world, the United States, our communities are changing. And they're changing in the direction that change was happening before. And this virus has sped up everything. It's just becoming more and more a digital world. So at times it's a little difficult to make comparisons with the 60s, 70s, and 80s, because it is a different world. It's not post-World War II anymore. The United States has a different position in the world than it did back then. But I think there are a few things to take a look at that you may want to, that the previous speaker mentioned. You may want to take a look this year. For those of you that take RMD, you don't have to take it this year. In your taxable accounts, you may want to take something off the table because there appears to be a disconnect between Wall Street and Main Street. And Wall Street almost seems like you have to hit it on the side of the head to figure out what's going on. The investment community, I don't know how many of you listen to CNBC or any of the other business news, almost is looking into 21, maybe even 22, it's hard to know, for earnings. And nobody knows that. So we're going to have, starting next week with the banks, we're going to have a series of probably mostly earning disappointments, okay? I wouldn't be surprised in the next quarter or two to see the market pull back 10 to 15% here, all right? You may want to think about, like I said, raising some cash, probably on the equity side of your portfolio. Since many of you didn't have to take your RMD this year, don't be overly greedy and take some profits if you have them, right? And stay in cash. I mean, CDs are like cash. So anybody that's getting more than 1% on a CD is doing extremely well. Or if you could pick up some corporate bonds or corporate bond funds to do a little better. You got a little risk there, but like the previous speaker said, the Fed is backing everything for the time being, and I don't see them pulling the carpet out right at this point for the next 12 to 18 months. Probably longer term, you're going to see some inflationary pressures by some of the issues that you heard. This huge deficit that you're talking about, but you're going to have some demand pull to do that, okay? That may not happen for a while because of this virus situation. So saying to call the shots here is difficult. It's more than difficult because you just don't know which way this is going. I think there's a better than 50-50 chance that you're having a change of administration in November. Some of us would probably say, thank God. You got to see where that's going to take you going forward. All right.
Okay. I'm back.
Hi, Phil is back. Mike Barr is a VP at Morgan Stanley, and he lives in Stonebridge. So he's our go-to guy when we don't have have you speaking. Okay,
it's fine. Go ahead.
I'm sorry, Mike.
Anyway, the point that I was trying to make is that since 1945, it's a great chart. Since 1945, one of the reasons why the markets have done really well is we expanded global trade. In 2008, it sort of hit a peak and rolled over, and then started to expand again, and now it's rolling over again. To me, that is a major, major problem for equity markets going forward. Because one of the things that, as many of you know, maybe all of you know, the US dollar is the world's reserve currency. Now, there isn't anything specifically that could take its place today, but the whole trade situation is very badly misunderstood by most people. In order for the dollar to be the reserve currency of the world, people in China, Japan, Korea, Saudi Arabia, etc., have to have access to dollars. And the way we have given them access over the years, as many of you maybe remember the word petrodollar that Henry Kissinger invented back in the early 70s. We told the Saudi Arabians at the time, price oil in dollars and we will defend you. So everything was sold in dollars that pertained to oil, and then those people that had those dollars bought our goods. But in order to get people to have dollars, you have to run a trade deficit. You have to buy stuff from foreigners to give them dollars so they could buy products in the world, and most importantly, help finance US deficits, which gets lost in all this translation and the rhetoric that comes out of Washington. So if we don't give people dollars, then the dollar can't be a reserve currency. That's why people are really screaming about, why is the dollar the reserve currency of the world? And people are attacking the dollar. I mean, one of the ways they will attack the dollar going forward is to sell treasuries. We need foreigners to buy our treasuries to support a $3 trillion deficit this year and $25 trillion worth of debt. So you're going to need foreigners to do that. But the United States, and this is not Donald Trump, and I'm not making political statements here. This started way before Donald Trump. We started to come back to the United States, in theory, to move inward. And the rest of the world is doing it also. So the world is in a transition now, and I clearly don't know what the other side looks like, but I know we're not going back to the way it was. In 1946, the group of nations created all these institutions, the World Bank, the IMF, the United Nations, NATO, etc. And most of those institutions are falling apart, if not have already fallen apart. So what's going to take their place? I don't know. But during these times of uncertainty, it's not going to be a pleasant time to be in the market. The Federal Reserve can keep on doing what it's doing, but I think at some point they run out of gas. You know, and think about this for a second. You know, we have 26 trillion roughly in debt. If the average interest rates on all our debt was 1%, that puts that number at 260 billion. And it's probably not, it's probably a little bit more than 1% now. So if you think interest rates are going up, think about what's going to get cut out of the budget to balance, to get anywhere near some semblance of normalcy. To go to 2%, you're talking about 500 billion. Defense budget is 700 billion. So, you know, this is not a political statement. You know, if somebody can explain how these numbers are going to make sense going forward and how people in the world are going to keep supporting U.S. treasuries because the dollar is the reserve currency of the world, I don't know the answer. But I could tell you one thing, the next 3 to 5 years or 6 years or 7 years, we're going to be wandering in the woods. And whether the markets, you know, go back to some semblance of normalcy as far as price earnings, price to sale, price to book, I don't know. I certainly think it's very possible. But this global trade business is a very serious issue. And I don't hear anybody talking about it. I hear people talking about it, well, you know, we don't like the fact that we have a trade deficit with China. But if we didn't have a trade deficit with China, how would they have money, dollars, to buy our treasuries? Recently, they started selling treasuries. Russia doesn't own any treasuries anymore. So who's going to be buying all these treasuries? Is it the Federal Reserve going to basically monetize our debt? Every time in history we had this, we have hyperinflation. So this is something I think that everybody has to think about. So, you know, if you want to take a good portion, some portion of your assets and play around in the market because you like it, that's great. But the real serious money that you have that is going to preserve your lifestyle until you die, if you fool around with that and you guess wrong, you know, there's no turning back. So, you know, I had some other charts and I wish I could put them up, but, and I copied this from somebody else's presentation.
You want to try again, Phil?
I will be happy to.
Steve, you still there?
Yeah.
Yeah.
So bottom middle of your screen, share it. Right. There you
got
go.
it now?
It's up and running.
Okay. All right. This is the chart I'm talking about. If you'll notice, this chart goes back to 1840. And, you know, basically we weren't a big trading partner up until World War I. And then, you know, we had a spike in the 1920s. And then we had a collapse into World War II. And that's when, you know, we went into the war. But if you notice, since World War II, basically global trade has basically expanded nonstop since that time. And here then we rolled over in 2009 when the world banking crisis, and nobody tried to figure out, they're still trying to figure out how to get out of that crisis. And now we're rolling over again. But I think that the world is turning inward. You know, everybody is not looking for global trade, and we're going to have new alliances going forward. We don't know what that looks like either. So I would tell people to read a book by a guy named Peter Zeihan called Disunited Nations. He tries to lay out where he thinks the power bases in the world are going to be, and it's based on defensible borders, food security, access to energy, etc. But that's over the next, say, 10, 12 years. But markets are short-term in nature. Let me see if I can get another chart up. I wanted to. I hate to. I'm going to try to do this again. Let me see if I can get this chart up. Hang on. It's frustrating to me as much as it is to you, and I'm sorry. I apologize.
Yeah, well, we're waiting for 5G. That's it.
Okay, wait a minute. I got this is one chart I wanted to show. It's on. This is a deck of charts. I'll get to this one chart in a second. There it is. Okay. This is a chart on the left inside this picture. You see all the numbers on there? It says C was just a correction, nothing to fear, everything back to awesome. You see that? And it's a number 12?
It's up there.
Okay. Well, the number one, I don't have all three charts up there, but number one says, we will not have any more crashes in our time. John Maynard Keynes, that was number one. Number two, I cannot help but raise a dissenting voice to statements that we are living in a fool's paradise and that prosperity in this country must necessarily diminish and recede in the near future. That was the president of New York Stock Exchange. There will be no interruption of our permanent prosperity. Myron Forbes, CEO of Pierce Automotive, 1928. Irving Fisher, the famous economist that everybody always quotes, probably the most noted at the time. There may be a recession in stock prices, but nothing in the neighbor of a crash. That was number four. That was September 1929. And then all these things happened between, the last thing was number 20, which is all safe deposits in banks and financial institutions have been sealed and may only be opened in the presence of an IRS agent. That was Franklin Roosevelt when they confiscated gold. So in my opinion, for whatever it's worth, we are going to be in the next 3 to 5 years, 7 years, entering another period similar to the 1930s. And this is very problematic if you're an investor. So, we had all this euphoria, and I think that what's happening with the FANG stocks is more euphoria than anything else. It's too. I'll try to get another chart up here. This is sort of indicative of today. I'm sorry.
No, go ahead.
This is the market as it was today. Dow down, S&P down, Russell down, crude oil down, gold down, silver down, 10-year bond, 60 basis points. The NASDAQ was up. And, you're getting stocks selling at ridiculous valuations. So, I think that, you have to be somewhat cautious. There's another chart in that chart deck that I just had up here. Let me lower this again and go back. I'm sure I can find it. This was a picture on Jim Cramer. I hope it's on this deck. There it is. Jim Cramer had the Dow's best week since 1938, and there was a headline: breaking news, more than 16 million Americans have lost their jobs in 3 weeks. That chart basically says what's happening in the markets is not happening in the real economy. One of the ways you should look about this is we always have inflation. We either have price inflation like we had in the 70s, and many of us remember that. We were young guys then and gals, or you have asset price inflation, which is what we've had for the last 30 years. So, I get a kick out of every day when I sit in my office and I have CNBC on all day long. I don't have the sound on, I just have the tape on. And, it's the difference of the markets versus reality. I mean, today they reported jobless claims, for example. They said 1.3 million new jobless claims, and it beat the estimate of 4 million workers. But they have a new category called job claims due to pandemic, which is not included in those statistics. There are 1 million people in that number. So the jobless claims today was actually 2.3 million instead of 1.3 million. And many of us know, I mean, we're living in this crazy time that we can't go out, or, you know, we can go out, but you can't go very many places in New Jersey. We don't know how any of these industries are going to come back. You know, some of them were heading for the ash can anyway. In my opinion, retail malls were heading for disaster anyway. But what's going to happen when and if we ever get back to whatever semblance of normalcy we call normal? I mean, the Freehold Mall lost Nordstrom's. They lost Sears a couple of years ago. They're going to probably lose JCPenney. They may lose Macy's. I mean, what happens to that mall? 32% of all people paying mortgages did not pay their mortgage in July. I mean, that is not the sign of a V-shaped recovery, which, you know, Larry Kudlow, who I know, you know, I mean, if you wanted to pick a worse chief economic advisor, it would be Larry Kudlow. Larry Kudlow couldn't get a job as an economist for the last 35 years when he got fired at Bear Stearns. So I think that, you know, you have to be careful of who you listen to, and you have to sort of calculate in your own mind where we are. You know, all of us, I would, you know, say are relatively intelligent, and most of us have done relatively well in our life. Otherwise, we wouldn't be living at Stonebridge, and I wouldn't be living at Regency. You know, it's a hell of a lot better than where I grew up in Brooklyn. But I think that at the end of the day, you know, we are living in uncertain times. And one of the things, we don't know what we don't know. And that's part of the problem. So when anybody could tell you that industry like airlines are going to be coming back, when United is sending out job, you know, furlough notices or requesting people voluntarily, you know, go into retirement to 20,000 people. Do you think a pilot can replace his income as a pilot by working in Walmart? So we're in a very difficult time. So, you know, I think that it's important to protect your financial well-being is just to be careful. Try to be somewhat risk averse. One of the things that nobody seems to be talking about to me, which is a major crisis in the next 2 to 3 years, is public pension funds. One of my, you know, when I was working at Eaton Vance, many of my clients were public pension funds. And, you know, I had dinner, goes back to about 2003 or 4, with the head of the Senate Finance Committee in Louisiana, because the state of Louisiana was one of my clients. It was about a $20 billion pension fund at the time. And he was telling me we have about a 2 or 3% underfunding problem in Louisiana. And he says, please help us adjust our asset allocation so that we can get rid of this deficit. And I said, asset allocation is not the problem. I said, you have to do one of 2 things. And he said, okay, I'm willing to listen. I will pretty well do whatever you want. And I said, well, you could raise taxes. He says, not politically feasible. I says, well, the other side is you can cut benefits. And he says, that's not politically feasible either. So that's where we are. And the state of Jersey is probably in the worst shape of one of the worst shapes of anybody in the country. It's certainly not the court, you know, Phil Murphy's is not the reason we have a crisis. We have a crisis that started when Christy Whitman was governor, and she didn't put in the money that she was supposed to put in. And no governor since then has put the right amount of money in. And every time, every year, you get further and further and further in the hole. Now, this year, which is another interesting sidelight, all states are running deficits because their sale tax revenue is down, gas tax revenues are down, etc. Where are they going to get the money? Somebody is going to have to get laid off because states cannot run deficits. So if they start laying off teachers and cops and firemen and any other public employees, which may be coming down the pike, not because they want to, but they're not going to have any choice. So these are issues that nobody seems to even want to talk about. I mean, Sherrod Brown, the senator from Ohio, talked about, some pension guarantee thing a couple of years ago, but that went nowhere. I'm not sure if anybody else, if the Democrats get elected, that they'll do any better with these problems than the Republicans did. But there's a revenue problem, and there is an expense problem. But the expense problem has been there for 30 years. The revenue problem is a real problem because we keep cutting taxes over the last 30 years. So ultimately, people are going to have to decide what they're willing to get, what they want from the government, and what they're willing to pay for, because that's ultimately where it's going. So we live, like I say, over and over again, we live in very difficult times. I don't know how many of you know one of the very good investors. He's on CNBC a lot. His name is Doug Cass. He put out something a couple of days ago, which I will read for him. He thinks that at best, we will have an 80% recovery in many industries. The disruptive impact of the pandemic will linger for years. Social unrest and reduced profitability and economic growth relative to consensus stand to be a feature of 20 to 2023. S&P earnings that happened in 2019 will not be exceeded until 2023. Now, in 2019, the S&P was about $160. So even at $160, we're at 20 times earnings. This year, I said earlier, people were estimating $100. So you're talking about 30 times earnings, which is pretty expensive. He said, in aggregate terms, COVID will likely have a sustained impact on the domestic economy and reduce production and profitability for several years. One of the stocks that keeps going up every day is Amazon, which is doing tremendous business because I think most of you know, you probably get packages from them every day. But their costs have gone up. Their employment costs have gone up. I mean, they're going to raise, employment from whatever, $8 an hour, $10 an hour, $15 an hour. They can't raise prices fast enough. So, something gets squeezed, it's called profit margins. And if we start building stuff in this country again, which is going to take us a long time to do, it costs a lot more to pay a guy in Michigan or Kentucky or Mississippi than to pay a guy in China to do the same thing. So you got profit margins going to get squeezed over the next 3 to 5 years. So, this is my talk. I think that, we have zombie companies now. We have something like $16 trillion of non-financial debt. One of the industries that I think is very important to an overall economy is the banking sector. And one of the industries that has not done particularly well this year is banks. Financials have done really bad. And the question is are the banks doing badly because people are selling the banks and buying FANG? Or are banks doing badly because their fundamentals are deteriorating? And I don't know the answer to that question, but I think that there is a lot of problem loans out there. Bankruptcies are going up every day of the week. So it's not a pretty picture. I just wanted to lay it out the way I see it. Again, it's my opinion. I'm not telling anybody to do anything, but just be careful out there. And I think I did my civic duty by doing this.
Phil, what I'd like to do is to ask Mike Bauer to say a few words, and then maybe we could open up to questions and answers. If
Fine.
that's all right.
Okay.
Yeah. Mike, you want to say something?
Yeah, I think we're in a period where I was saying before of disconnect between Wall Street and Main Street. Okay, I think everybody sees that. I agree that I said that I think before, and I'll say it again. I think you should be raising some cash out of your equity portfolios. I think there's quite a transition going on, especially in this country. The virus has moved it along faster than what it was before. I think we're becoming more efficient. I think the nature of our society is starting to change. And we're moving along with that, okay, from that point of view. Yeah, I think there's probably some structural issues that were brought up that are certainly going to be addressed. I think taxes will probably start to go up, if not in 21, by 22 for sure, to address some of the deficits that you see. Some of the other things that are talked about are global structure problems, as I see it. Going back in history, the United States was king in many of the decades that you spoke about. That's changing, okay? And we got to get used to the change. On the demographics, the good news is that people are living longer, and that's the bad news also. So you have a situation now where once this baby boom generation moves on, the demographics in the United States will probably be a little better financially, but we won't be around to see that. That'll be, in my opinion, another 10 or 20 years out. But there's no doubt about that. What you're seeing in technology, which the market is probably reflecting a little too aggressively, is where this world is going in the next 2 decades. You certainly don't want to put your money too heavily on fossil fuels these days, because you can see that changing big time. Okay. So there are a lot of things, I think there are a lot of things that are changing. The United States has an amazing ability to adapt to change. Okay. And I think we'll continue to do that. In the meantime, I think you'll see the market pull back a bit, and you'll see some opportunities there. And then gradually, hopefully, and again, the virus is going to run the short-term part of this. So gradually, if we get drugs which appears to mitigate it, you don't have as high a death rate, and then eventually a vaccine, is that going to be more like a flu vaccine or a smallpox, different? Seems to be leaning right at this point more like a flu. Maybe we'll get lucky and it'll be a 1-time or a 2-time thing you take, and that'll be it. That could get us going, I think, by the middle of 21. I think you're going to have some elevated unemployment for a while. Dislocation definitely in employment. And it's hard to know what the new normal is. It's my first pandemic also. So, it's hard to make a guess here. I think the Fed is probably doing a pretty good job here in putting the fingers in the dike right now. Sooner or later, that's going to slip a bit. And I think that's where the market will tell you about that's going to slip. Hopefully they can hold it back long enough until we can get on top of the pandemic. But, that's a tough call right at this point. So for short term, I go back to, I think it'd be smart to take some profits here, put some cash in your money market, and hold on to it for a while. And let's see how it develops, and let's see how science takes us pretty much out of the short-term situation.
Okay. Are there any people who want to ask questions? Just unmute and ask your question. And
yes, I have a question. So we're saying that there will be inflation. That's probably true. So what do we have? If we are conservative and we balance equities versus bonds, both will lose at the same time. Is it a correct assumption?
Well, it depends on the timing, because you're going to get, you're right, you're going to get some long-term inflationary. That doesn't mean right away, but you will get some long-term inflationary push. You could have a raise of interest rates at that point. Okay. I mean, it depends at what point in the cycle that you're talking about. I've never recommended before dividends to go into utilities and things like that to get your income, if that's where you're looking for your income. But you're taking a look certainly on treasuries and CDs. You're not getting your income from there. So people that are looking to live off some of their investments are working harder to get the same amount in the last year or two. No doubt about that.
Phil, did you want to comment on it?
Well, I think I agree. I think that, as I said before, bonds right now are not giving you very much unless you go down in quality. Right now the Federal Reserve is your backstop because they're basically buying everything. But if they stop, you're going to start 50% of investment grade bonds are rated BBB or lower. So, you're buying a pig in a poke. If you're really good at reading balance sheets, you might be able to find some jewels. But, buying bonds right now at the end of a 30-year cycle, you're really shooting crap. So, try to buy companies that have strong balance sheets that pay good dividends, and that will try to maintain those dividends. Take a stock like Boeing.
You could be also looking at some preferreds out in the market. It may give you, depending on the company, and they're a step above, on the debt scale. So take a look at those also. I think we mentioned that in the last meeting or two. Again, you're going to be stepping up on risk if you need your return.
But again, you really have to look at balance sheets now. We don't know yet the financial impact on companies. One of the driving forces that drove the market up from its bottom in 2009 at the magic number of 666 was the bottom of the S&P 500 in 2009, March of 2009, was the fact that companies were buying back stock. And it probably do about 40 to 50% of the market rise over that period of time was companies buying back stock. A lot of companies that did that at the risk of their own companies. One of them is Boeing, whose debt was just downgraded to probably just about junk levels. And they bought back $60 billion worth of stock, and now they don't have cash flow to pay the bonds. I mean, we are in insane times. So, I think what Mike, if that's your name, Mike?
Yeah.
Mike is with Morgan
Stanley, I know. Okay. I spent a lot of time with Morgan Stanley. As a matter of fact, 2 weeks before September 11th, I was in their headquarters in the World Trade Center, seeing their manager research due diligence area people at the time. But in any case, preferred stocks are great. I think that if you find good companies and they have preferred stocks, that's a good place to earn some excess income.
There are more questions from anyone?
Yes, I have a question.
Sure.
Where, I know, first of all, thank you, Len, Mike, and Phil. Appreciate this.
Awesome.
But where can you earn money markets for more than 0.0203 or CDs at 1%? I'm not aware where. Do you have a list of something that you could share with the group, with the Stonebridge, of we could even earn 1% on a CD or money markets that,
The only CDs that'll get you even 1% right now are going to be what we call callable CDs. You're going to go out 3, 4, 5 years, and they have a call feature maybe 6 to 12 months. So basically that means you may be stuck, well, you liquidate the CD. You may be stuck with a CD at about 1% that doesn't get called. If it gets called, that's what you want it to do, okay? Otherwise, CDs going out a year are giving you somewhere between 0.1%, give or
Right.
take.
So,
Let me,
right.
can I make a comment? Because I have a bunch of, I've been looking at that for a while, and I can get 1% with no CD, no risk from two places, from Marcus, which is Goldman Sachs, which is paying 1.05, and Capital One. Both are online savings accounts. You just transfer the money from your whatever you want. They had been 2% literally 3 months ago, and then they went down to 1.3, and now they're at 1. But you know, there's no risk because they're FDIC insured up to 250,000 or 500,000 for a couple. So to me, I found that to be the best of the bad.
And I'll probably tell you that they'll probably go down to 0.75 and 0.50 in the next 3 to 4 months. Okay,
Could
but
be.
go ahead.
Could be.
You're not going to be able to keep up even with nominal inflation that way. Okay, so if that's what you need, then you have to look at other things. I mean, basically, a 1% CD, you're not even coming out flat after the year. Okay,
You're just protecting against losses, really. That's all.
loss of principal. That's it. That's exactly right. So you're losing definitely some buying power. All right.
Are there any questions for Phil at this point?
Well, yeah, I mean, sort of the same line. So if the stock market is a dangerous place right now, and you definitely don't want to be in bonds, as you talked about, and even cash with the deficit spending and possible losing of the world currency, cash itself is probably not a good place. Gold seems to be somewhat strong now, and all those factors would make gold go up. We're shorting the market. Is there anything else left?
Well, you know, I mean, precious metals always go up when you have uncertain times in the financial markets. You have clearly the Fed is printing money. I don't have any other words for it. And that's what's pushing people into things like gold and silver, which have had a store of value going back 5,000 years. And I think that gold should be in everybody's portfolio, in my opinion. And I think that you're going to see gold prices a lot higher over the next several years. Unless, of course, you know, the United States does what it did in 1933, which is confiscate gold. Not out of the realm of possibility. But the Federal Reserve made a decision in 2009 to protect the upper wealth of this country at the expense of savers and workers and pension funds. They're the ones that need income. The top 1%, they needed the markets to go up. So what the Fed did is basically buy bonds and push the market up, created liquidity, and created probably, you know, the market is quintupled since 2009. 666 to 3,200 roughly. That's up 5 times. But the people that relied on fixed income, like pension funds, insurance companies, they got killed. They have nowhere to go. They can't buy really, you know, high yield bonds and all this other kind of stuff because, you know, they just can't take the risk. So to answer your question, you know, there really is no safe place. And from what I'm seeing over the next, you know, the last couple of days anyway, rates are going down even lower. Now, will the Fed push rates to zero? Not out of the realm of possibility, in my opinion.
Mike, you want to add anything?
Yeah, I don't know any better than Phil on you know, the Fed. I think the Fed will keep it here at this point. In other words, I think they took a look at Europe and Japan, and there's no benefits to going to negative interest rates. So I think you're moving along at rock bottom as far as that. I think as far as the individual investor here, it depends what you need your investments to do. If you need more income, then I would probably lean to something like utilities and get again, like Phil said, look at the balance sheet. There are some solid utilities out there. Utilities have pulled back a bit. They may get hurt a little more because of lack of commercial and industrial usage. So their billable hours, if you will probably come down in the next couple of quarters. But they're pretty well financed. They're controlled by either the states, the Public Utilities Commission, and have been pretty steady over the last 50 to 60 years, and will give you a dividend between 3 and 4.5%.
Yeah, that's assuming though that they're going to maintain that dividend. Like in
Well,
my
of course,
portfolio, I had
there's a risk. There's always a risk. There's always a risk on banks and common stock, but compared to most, if you take a look and back test it, dividends and utilities have been pretty steady.
Okay.